AgCredit. And today we have an opportunity to share our perspective and insights. But before we get started, why don't we have Kristen, our regional marketing manager, bring up our slide deck. And then what I'll do is I'll walk you through a quick little overview of our agenda and our participating panelists. So if we can go to the next slide, Kristen, please. So today we've got this, what I call the all-star lineup. We're going to hear from Matt Clark. And just before we go through this, a quick takeaway is this here is your most important slide of the day. I realize that this call is being recorded and will be a part of the wine growers library, but these are the names that you guys have access to. Jot them down. You've got the phone numbers. And the first introduction here will be with Matt Clark. He'll present a broad-based overview of kind of the economic state of the state. And hey, who has access to an economist where you can just pick up a phone? You've got that now. So Matt does want to hear from you. He loves interacting with our clients and getting the word on the street from the market. So don't hesitate to call him. Todd Combs, we're going to hear from Todd Combs. Todd's our real estate appraiser, and he'll help us drill down and take a look at some more industry-specific trends. And then we'll hear from Shannon Antonini. Shannon's in short supply because she's our crop insurance agent. And as you guys know, fire and smoke taint is the state of the state right now. And so our crop insurance team's working really hard trying to get everyone squared away and taken care of, while at the same time getting into the new selling season. So we'll hear from her briefly. We'll also hear from Deanna Martin, one of our lenders. And Deanna will have some ideas on how to use various loan products to maybe navigate some volatility in turbulent markets. And then we're going to hear from Scott Clifton, which will be a real treat. Scott works on our credit resolution group. And what Scott does is, hey, sometimes things go bad. And sometimes it gets real hard to make your payments. Well, Scott works with our customers that are in that situation, and he's really creative with loan restructuring ideas. He'll give us some ideas on how to interact with your lender when things start kind of going sideways. But neither here nor there, that's our team. And what I'll do is I'll give you a quick overview of American AgCredit briefly, and then I'll hand it off to Matt. So before we get too far along, I just want to make sure I thank you guys for attending and thank our partners at the Sonoma County Wine Grape Growers. So appreciate it. American AgCredit, we're a financial cooperative, which is a little bit unique. We are not, the Sonoma County Vintners, I apologize. We are not a publicly traded company. We are owned by our borrowers, so much appreciated. What's cool about that is being owned by the borrowers is our customers basically elect our board of directors. It keeps us focused in agriculture, and within the Farm Credit footprint, we all actually have charter territories, and within those charter territories, each association will kind of just manage those commodities in those regions. Our region, with our commodities, we're the 5th largest association in the Farm Credit system. So we've got a lot of capital, and with that capital, it helps us stay with our customers longer during turbulent times. So we're situated very well for the current economic climate. Next slide, please. The funding model also is kind of one of our competitive advantages. We sell bonds on the open market. We're not using deposits. So we'll have a slide deck on that real quick too next after this. But just a quick overview. Most of our business is actually in California, but we do have a footprint that goes into Kansas, Colorado, a little bit of New Mexico. But with that broad footprint, near and dear to our heart is the wine business. It's still 18% of our portfolio, and our portfolio is about knocking on the door of $13 billion. So it's no small deal. Next slide, please. So a little bit about our funding source, which kind of makes our competitive advantage. When you're on deposits, it makes it really difficult to make long-term commitments because you've got the theoretical run on the bank. what we'll try to do is we'll try to match funds. So if we need to do a 25-year loan, we'll sell a 25-year bond and then just kind of play a spread based on what we think the risk and cost of servicing is. That long-term funding source really is important in agriculture, because as you know, as soon as you get into agriculture, you're talking real estate, you're talking long-term, and you're talking multi-generational. So neither here nor there. With that quick overview, I'll hand it off to Matt Clark to give us the economic overview. Thanks, Matt.
Thanks, Clay. Yeah, I realize that macroeconomics is probably a topic that not a lot of people want to talk about right now, but hopefully I can give a real broad overview as I see things. I certainly don't have all the answers, but I'm happy to give you my view, and then happy to talk as much as we want in the Q&A about it as well. So on the first slide, what I'd kind of like to show is just kind of what the general global macroeconomic scene looks like. And I think it's best illustrated as a major global shock. So if we flip to the next slide, what you'll see is an image that IMF produces every October. And it's a global view. I hope you could hop one back. We should see two pictures of kind of the globe, and it's IMF's view of what global GDP would look like. If you could flip back, there we go, perfect. If you could think through this part with me, what you see on the left is the IMF's view of the 2020 global economic situation taken a year ago, so October 2019. And at that point, their view was generally modest to good growth across the globe. So only a handful of countries, as represented by that dark blue color, were expected to contract in 2020, and most countries were somewhere in that 3 to 6% growth range. Global GDP was expected to be about 3.5%, so not great, but still fairly positive. Of course, coronavirus hit, took out the entirety of our plans, so to speak. So what you see on the right side is IMF's most recent projection for global economic growth in 2020. You'll notice here just about every country is in that dark blue, meaning IMF expects them to contract. To really highlight that, IMF expects 198 of the possible 226 economies to contract in 2020, largely considered to be the sharpest global decline since the Great Depression. So a very unfortunate chart to look at here. You'll notice there's a few countries that are still hanging on with decent growth, but overall, IMF is expecting a global contraction of about 4.5%. To say that another way, in the time frame from October 2019 to October 2020, we lost roughly 7% of growth. If you think about it in total change, what was expected plus what was lost, roughly a 7% swing. So a massive hit to the total global economy. The good news is you'll see here on this next slide, the IMF does expect a general bounce back in 2021. So here's the same slide, or same general picture of the globe. Anything in the light blue is expected to grow about 3%. Anything in the green is expected to be a more of a high growth scenario. Only 10 economies are expected to contract, so that's a very positive sign. And the global GDP is roughly 5.2%. So very sharp bounce back overall. You'll notice some of the emerging markets are expected to bounce back sharper than the advanced economies, which is a very good sign for some areas that would need growth. However, what I would give a hypothesis here to you is that this almost all depends on our ability to contain the virus. I know we've had some positive news on vaccines recently, but deployment and ability to contain and stop is absolutely fundamental to making this picture become a reality. Again, to dive into that a little bit further, the next slide will show you the impact that the virus has had on our ability to engage in the economy. And I think this is one of those things we all know, but to see it on a chart is a slightly different measure. So the chart on the left here is high frequency mobility data. So the blue line is the Federal Reserve Bank of Dallas's mobility and engagement index. This is tracking Apple Watches, cell phones, GPS, etc. It's tracking how are people able to get out of their home and move and engage in the economy. As you would expect, right off the bat, for the first handful of months, there wasn't a whole lot of change. People were still able to move around and engage in the economy. However, of course, with COVID hitting in roughly early March, or not hitting, but at least being fully recognized and restrictions going into place, the mobility and engagement significantly declined. It has since rebounded, but in truth has been very stagnant since about July, meaning we haven't done a good enough job containing the virus to allow people to feel confident in going out and engaging physically in the economy full speed as they were prior to that. Another measure of that would be seated diners as kept by Open Table. The year-over-year look follows a very similar pattern. Of course, as restrictions went into place, March wasn't really seated dining. Picked up some restrictions were able to edge off over time, but really there hasn't been a significant increase for the last several months, meaning we've hit a bit of an impasse on this. The chart on the right is another way to think about this. This is Oxford's Government COVID Stringency Index. This is tracking the government's response to COVID and how stringent have their restrictions been on allowing people to move around within the economy. I tracked a few countries here just to kind of give you an idea of what it looks like globally. Of course, China went up sooner than others, later recognized in other countries. You see the United States in green. And frankly, there hasn't been a whole lot of change in stringency since March. And unfortunately, if you look at the COVID numbers, they seem to be getting worse, which, given some of the news we've received the last several days, once the data catches up, I would expect these stringent restrictions to increase, or the stringency index to increase here for the United States in the green once the data catches up. All that is to say, because we haven't done an adequate job in containing the virus, we haven't been able to lift restrictions, which hasn't allowed people to get out and physically engage in the economy. In the next slide, you'll see the impact that that's had on the actual economy. So here on the left, I'm tracking consumer spending data and income data for small businesses. So in the blue is consumer spending of all small businesses as indexed to pre-pandemic, kind of your January timeframe. As you would expect, through January, February, and even early March, there wasn't a whole lot of change. As the measures came in that would restrict our movement to try to control the virus, consumer spending significantly declined. It was fully recognized. You had people that were being laid off. Obviously, consumer spending declined. It regained some ground through about July, but has quite frankly remained fairly flat since then. That's also true of small business income. If you look on the green and the sort of mustard colored line, it's also true of income at these businesses. I have all small business in green, and I have hospitality and leisure in that mustard color. Again, significant drop off, some improvement till about July. And then frankly, it's been fairly flat, which would indicate a very unfortunate trend of just not being able to get out, engage in the economies, spend money, businesses to make money, which is quite frankly, it's very unfortunate to see that type of spending at these businesses. Same is true here. I have it again, looking at all businesses on the right. I added hospitality. This is business income. I added professional services into this. Slightly different look here as well, but fairly similar. You'll notice business income just has not been able to move the needle fast enough. So although we've changed the systems in which we employ our capital, so we're more virtual, so to speak, we're more internet-based, we're coming up with drop-off solutions, we're coming up with drive-through solutions, we haven't been able to recover what we lost on the income side, which is, it's particularly disheartening to think about that. As we move to the next slide, what I would say is until we get the employment situation figured out, until we can contain the virus side of it, get people hired, it's pretty unlikely that we'll see the consumer spending pick up past the level that it was and get business income past the level that it was. So what you have here on the left is the U.S. employment situation of initial unemployment claims in green and continuing claims in blue. While it's true that we've made significant progress in terms of continuing claims since the first few weeks of the pandemic, we still have roughly 6.5, 7 million Americans unemployed, which under any normal circumstances would be the worst ever. Looks slightly better now because we're just comparing it to a few weeks ago. But unfortunately, we haven't been able to get the businesses open. We haven't been able to control the virus in a way that allows consumers to confidently engage back in the economy. As such, our unemployment situation is a little bit bleak. Until we can get some of those things turned around and back in place, it'll be a bit of a long slog. I'm hopeful that the IMF is right and we can get that done in 2021, which would then turn the table quickly, I would imagine, and be a good positive bump in 2021. But a lot of that depends on a number of factors, some of which are economic related, many of which are actually health related. I won't read my summary conclusions to you there, but I'm happy to answer as much as I can in the Q&A. And I'll at this time turn it over to Todd. Todd's in our real estate section. I love talking with Todd. He's got a lot of great information for you. And again, I'll be on to answer questions towards the end. So thank you. Todd?
Thanks, Matt. Great job too. And as Clay alluded to, Matt is a great resource. I bug him all the time, and I encourage everyone to use that contact info to reach out with any questions. Again, my name is Todd Combs. I'm a senior appraiser at American AgCredit. It's mostly specialized vineyard and wineries, Central Coast and the North Coast. And today I'll be talking about grape contracts, real estate, along with some bulk market and what's going on there. I'd like to let everyone know personally, I've been supporting the wine industry. My wine consumption has definitely gone up over the last 9 months. So I'm doing my part. With that, we can go ahead and get started. We can go to the next slide. We're going to walk through 2020 and with headlines, kind of what we were going through and where we're at now. So early on, we had some concerns with consumption and oversupply. So early January, US wine consumption drops for the first time in 25 years. What they're saying there is we've been increasing, over a long period of time, and that rate of increase has now started to decrease. Another headline in January, millennials prefer downing a hard seltzer to uncorking some wine. So this is playing into that competition, hard seltzer, craft beer, cannabis, that still is there. And it's something we were highlighting earlier in the year and is going into 2021. Next, California grape glut starts to bite. That's just showing that oversupply situation. The next one, the same thing, more wine grapes could go unsold, analysts believe. So that's playing into where we were at with a big crop in 18, decent size in 19, going into 2020, the state of the grape market. And we can go to the next slide. So after those early concerns, we had these new challenges of, like everybody knows, COVID and wildfires have been on topic all year, especially of late with the wildfires. So the pandemic makes winery buyers skittish about buying grapes. The pandemic will create big revenue losses for the wine industry. Again, that next article, suffer losses this year. And then we're getting into the smoke and the harvest. Smoke taint test situation unacceptable for growers, and that's in September. These last two in October that I'm highlighting plays into the uncertainty in the market. So many California wineries will make no wine this year because of wildfire smoke. And the next week, a different article, 80% of Napa wineries are moving forward with the vintage. So what's happening with this harvest? How much quality, wine are we going to get or not get? So there's a lot of uncertainty out there, and I think a lot of these headlines play into that. So with that, we can get into the next slide, which is going to cover some of the silver lining, some of the things that do pop out, more bright spots. So strong wine country real estate shift. That's talking about the lifestyle, the rural estate, people from the cities moving to the country and how that's benefited the North Coast, Sonoma, Napa. Off-premise wine sales are definitely up 27, almost 30%. So that is a bright spot, and that accounts for, I believe, around 25% of total sales. So that is something that should continue as restrictions maintain. Bulk wine market activity up amid demand for well-positioned off-premise brands. again, those successful off-premise programs are doing well and they need more wine. So the bulk market activity started to increase before the fires in August there. Okay, for the next slide, we're going to get into what happened with this crop and smoke taint. So we started off wet and cold at bloom, some late heat waves. Overall, I'm hearing a lighter crop, and this is regardless of smoke of 10 to 30%. Some of the vineyard managers I've spoke with reporting 20% of their acreage not harvested. I have one interesting example. This is actually on the Central Coast in Monterey County. Very large manager there, over 10,000 acres, and he said that 40% of the acreage he manages was not harvested, and most of that was Pinot Noir. So that will play into the bulk market and the grape market for Pinot for sure going into 2021. Some other notes from talking with people: estate wine clients were more willing to harvest their fruit after spending so much money getting to that point. It's worth the risk of harvesting, seeing if the quality is going to be there. Really tough situation for growers. Some large wineries rejected fruit. Some growers were able to find new buyers during that transition of harvest. And some right now are currently in limbo waiting for quality adjustments. So say they had contracts at 4,000 per ton, with the wineries saying, okay, we're going to take the fruit and then we're going to test it. So there can be quality adjustments down to, 2,000, 3,000 a ton. We just don't know. That's kind of in process right now. And that touches on an interesting, aspect of the market too, the Grape Crush Report, and how that could impact the average price per ton. So you have a lot of very high quality fruit that likely, or some of it is not harvested. So that doesn't even make it into the Grape Crush Report. And then you're going to have some quality adjusted fruit that was, say, contracted at county average and now is going to get adjusted down for quality. So just a quick plug: in mid-March, right after the Crush Report, the final comes out, I'm going to be doing a webinar, and that's going to be with Jennifer Van Court with the USDA. She's a statistician there. And so that's going to highlight all these nuances of that Grape Crush Report with what happened at this harvest. So we'll make sure and get that out to the Sonoma County vintners for an invitation. The next thing I'd like to highlight, it has to do with that consistency, what we're looking for in the market with growers, labs, crop insurance, some standardization to get everything measured in a way that people can make informed decisions, within that tight time frame of harvest. That was a big challenge for everybody this last year. Okay, so let's get into the bulk wine market. You can click it one more time to pop up the graph, I believe. There we go. So this is just highlighting the Sonoma County bulk wine inventory. This is from SCION, a recent publication they produced in October and November. So you can look at how we'll highlight Pinot Noir here. So you had 400,000 plus gallons throughout the year, and then you significantly see that come through in August, September, and October, dropping down well below 200,000. So again, that's highlighting the notable off-premise brands sparked this activity in August. The light crop plus the wildfires really increased the activity. So that lower inventory and increased prices is what we've seen. In November, it has kind of leveled off. There hasn't been as much activity. So going into 2021, it seems, from what I understand and what I've read, a more balanced position going into 2021, which is expected, going into next year. So we can go to the next slide. So we're going to highlight Pinot Noir a little bit. Sonoma County grape prices. These are highlighting, the 5 major varieties that are grown. So over the last, 10 years, 41% increase. Between 2014 and 17, we definitely started to see expanding Pinot Noir areas, and maybe some more disparity between some of those contracted grape prices and bottle prices, maybe some gaps growing there. So you had a light demand in 2019 after a large 2018 crop, and that continued in 2020 because of the oversupply situation. Limited spot market activity, new contracts were limited prior to fires and harvest. From what I've heard, and this isn't across the board, so this example is just for fruit that they were getting contracts for, say, $400 to $4,500 per ton, county average plus, during that 16, 17 timeframe. For new contracts in 2021 for those same types of grapes, I'm hearing from managers, they're hearing pricing maybe more in the mid threes. So it has pulled back a little bit. Overall, very strong demand and prices for the most established locations, estate vineyards, vineyard designates, those remain strong. Overall, less uncontracted fruit is expected for 2021, with the grape, supply being more balanced after a lighter crop, along with the bulk market being in more balance. Now we're going to get into real estate. I'll just touch on some of the high points. The biggest thing that's happened has to do with the rural residential, the vineyard lifestyle. That's been very active. So the main driver here is remote work flexibility from the Bay Area. Most activity, Dry Creek, East Sonoma, West County, East Petaluma, under 5 million, some activity around 10 million. What's not selling as well are the bare lots, properties with balance issues. So say there's a lot of vineyard and it has a very beautiful, enormous house on it. It's hard to balance that, a buyer who want both of those things. And commercial vineyards without side appeal. So this next slide is going to highlight a recent presentation done, and this is from Compass Real Estate. It just shows the sheer number of transactions. This is over $2 million in Sonoma County. So 100 transactions Q3 of 2020. And I don't need to explain all the other quarters. You can just see it on the graph. Again, Bay Area remote work flexibility, slight increase in values with this demand jump. Value allocations really are about the home, the site, and secondary with the vineyard and the crop. So that is a lifestyle play, and that market has stayed strong. Next, we'll touch a little bit on commercial vineyards, some 2020 trends and takeaways. So this table on the left is from the California chapter of the ASFMRA. They do the Lands Trends publication. And this is from 2019. The 2020 will not come out till March. And this is just highlighting each of the categories within Sonoma County that are broken down by value. And what I want to really just get across instead of going through each one is, for commercial vineyards, what we've seen is fairly limited activity, relatively stable values. And so the vineyards we've seen that have sold with vineyards that are, say, midlife or older and do not have contracts, we're seeing some discounting there, and that's across the coastal regions. For midlife to younger vineyards with contracts, everything's going well, seems stable, just plugging along. And the demand and the pricing for the high quality, really estate, quality-driven reputation vineyards are still doing very well. There is quite a bit of inventory. There's a lot that is going to play out. We expect in 2021, are seeing a trend of more wineries selling too. So yeah, a lot to look for in 2021, and we'll be on top of it. We have a great group of appraisers in the North Coast, Central Coast, and the Southern California as well. So please reach out. If you have any questions, I'd love to answer anything at the end of this presentation, or you have my contact information. And with that, I'm going to turn it over to Shannon with crop insurance. I'm hoping I left everybody plenty of time. I know there's a lot of important stuff to cover. So Shannon, go ahead and take it away.
Thanks, Todd. If we could flip to the next slide. I'm just going to go over the basics of crop insurance quickly. I know I've done a lot of calls this fall. Probably a lot of you have heard my spiel already, but we'll get through it. Crop insurance is a government program. Insurance is by grape variety, so you can have different coverage levels for different varieties. There are optional units based on non-contiguous land, and contract pricing is available, which we'll get into a little bit deeper. So you can insure all varieties, or you can insure just select varieties, but you are required to insure all acres of a variety in the county. Eligibility, vines must be in their fourth leaf or in their third leaf after grafting. And actually in 2021, vines that were planted, Uber vines or bench grafted vines were also insurable in their third leaf. And units can also be broken up by crop share. The property owner can insure the crop, the operator can insure the crop, or they can each insure their own share. Next slide. The policy is based on the average tons per acre that the vineyard produces. It's a rolling average. We start with a minimum of a 4-year average, maximum of 10 years. The first year of insurance, we can kind of pick and choose how many years we start with to come up with the highest average possible to give you the best coverage. If the vineyard has, a young vineyard has less than 4 years of production records, then we can use county averages, or we can ask the underwriter to set a yield based on based on the variety, what that vineyard's expected to produce, what it has produced in its first or second year. Coverage starts at a 50% level. It increases in 5% increments, and it goes up to 85%. Catastrophic level is a 50% level of coverage. It's 100% subsidized. So you pay a $655 fee, and that is per variety per county. If you have multiple locations in the county, all of the fruit harvested off of all of the locations is considered one insurance unit. So that's kind of the disadvantage of CAT, but it is a super cheap safety net if you're looking just to have some protection, but not a lot. The policy is by a unit guarantee. So we take that average tons per acre, we multiply it by the level that you select, and then multiply that by the acres of that variety to come up with your unit guarantee. Contract pricing option. Each year, the RMA, which is the Risk Management Agency, sets prices by variety, by crush district. For 2021, they used the last 5 years crush reports to come up with these prices. So we actually saw some pretty good increases. The last 2 years, they didn't tell us what they were basing that on, but Cabernet for 2020 was $27.70 a ton. This year it's gone up to $29.36. And actually Pinot Noir for 2020 was set at $34.90 a ton, and that's jumped up to $37.74. So some nice increases there, getting those prices closer to what growers are actually receiving. In order to utilize the contract option, sorry, can we go back just a little bit? To utilize the contract option, you have to show that all acres of a variety are under a written contract. If you have multiple contracts, we do a weighted average across all of those contracts, and the maximum price is double the established price. Crop insurance covers all weather-related damage, pest, disease, wildlife, smoke taint. Smoke is a result of fire. Fire is an insured cause of loss. Poor quality, sorry, that comes into the smoke taint and kind of goes back to some things that Todd was talking about with wine that's currently in the wineries, fruit that was brought in, and we're waiting still for prices to be established. We are seeing a whole lot of price adjustments this year, which affects how the crop insurance payment loss payment is calculated. And so one important thing to remember as a grower when you're getting into a situation where a winery wants to wait and see how that wine develops, crop insurance can't pay you until that winery establishes a price. We had a lot of questions, mid-August or mid-September as harvest was going on, and we're dealing with smoke taint, and these negotiations are going on, and at times wineries were asking for a year before they were going to establish that price. So as a grower, you're not getting paid from the winery for a year, and your crop insurance can't be settled out for a year. So it's just really important to consult your crop insurance agent when you get in these situations, so you fully understand the impact of your loss and how that claim is going to be paid. Some important deadlines. January 31st is the deadline to purchase crop insurance for grapes in California. May 15th is the contract deadline. So that's the date that you have to provide those written contracts in order to utilize contract price. Next slide. Oh, one more thing that I'll add to that is reporting notice of damage. It is imperative that you report damage no later than 60 days from your last day of harvest for that variety. After that date, your claim will be denied flat out. There's nothing we can do. Best if you report before harvest or as that damage is actually occurring. but 60 days from that last day of harvest is absolute drop dead. So as I'm sure you know, we're in the thick of it right now with settling out these claims, getting new people signed up. And just, you know, I encourage all of you, if you already have crop insurance, really look at those policies, because it's not till you're in a loss year and have these major losses that you truly understand what you've insured or where your gaps are. So consult with your agent, give us a call. We'd be happy to go through it with you and make sure that your coverage is adequate for your operation. Now I will pass it on to Deanna.
Thank you, Shannon. Good morning, everyone. Hope everyone's doing well. My name is Deanna Martin, as Clay mentioned earlier. I am one of our lenders here in the North Coast, based out of Santa Rosa. And I want to take just a few minutes to kind of discuss different loans and lines of credits that might be useful to the operation. So with that, we'll go to the next slide. We're going to be, again, going over different loan structures that can provide access to capital for operations, as well as leases that can help preserve working capital for operations. And these are just different financial management tools that might be useful to your wine operation in uncertain times. Now, one thing that's not listed here that Shannon covered in her presentation is crop insurance always is a good management tool when it comes to risk management of the investment in that crop. So with that, we'll go ahead and dive into the next slide. We're going to discuss here different types of lines of credits and what they can be used for. But I always do like to start out by saying that whenever you're working with loans or debt facilities, talking to your lender, having good communication with your lender, and discussing things early with your lender really is key to building that relationship and making your lender be better equipped to understand the unique needs in your operation. Each winery is different. They're different in size, different in route to market, the clientele that they're serving. And so with those differences, it does present a unique set of needs for each winery. And so communicating with your lender really better equips them to understand how to structure the right tool for your operation when it comes to a loan. Now, back on the lines of credit, there are two different types of lines of credit that can be used for getting access to capital for your operation. The first one is revolving lines of credits. It's a short-term line of credit in nature. So generally, you'll see them structured from 1 to 3 years. They can be used for operating expenses, working capital needs, funding inventory builds. It can also be used for just covering shortfalls in your monthly cash flows, or a couple months that might have a short cash flow period. So those are useful tools to cover kind of those short-term expenses. They are secured against personal property, such as receivables, inventory, equipment, or crops. Now, equity lines of credits are a little bit longer in nature. Similar to revolving lines of credits, they can be used for operating expenses and working capital, but they can also be used for a little bit longer term expenditures, such as CapEx needs or winery improvement projects, development needs. You'll see them generally structured for the revolving period anywhere from 1 to 5 years, followed by a term out period to help keep payments low over a longer period of time. Different than a revolving line of credit, equity lines are real estate secured. So the bank would be looking for real property to back that line of credit. Going on to the next slide, we'll talk about term debt. There are two different types of term debts that can be useful to an operation. The first one being intermediate term debts. Intermediate term debts can be used to take shorter term debts, kind of stretch them out over a little bit longer period if there's, cash flow constraints within the operation in the short term. Can be used to fund equipment purchases, CapEx needs, or other development projects, as well as consolidation. You'll generally see intermediate term debts structured anywhere from 5 to 7 years to help stretch out that repayment. And they can be secured against personal property, such as machinery and equipment, or real estate, depending on the specific need of the operation and what's being financed. Now, mortgage debt, it is longer in nature, anywhere from 15 to 25 years. Can be used for debt consolidation, a useful tool when you have quite a bit of short-term debts that are really creating a burden for the operation, getting them consolidated onto one payment, stretch that out over a couple of years can help on the short term, keep some of the payments lower. As well as it can also act as an additional safety net in just pulling out equity out of the property, kind of sitting or parking that cash in a savings account for a rainy day fund. And then mortgage debts, of course, can always be used for purchases or acquisitions if your operation is in a time of expansion. Now, mortgage debts, very similar to equity lines of credits, are going to require real estate security. So the bank would be looking for a first lien position on real property. And just the comment here, every lender does do things a little differently, has different ways of structuring things. So communicating with your lender of what's going to be the best fit and the best structure is recommended. We'll go ahead and move to the next slide where we'll talk about leases. There are two different types of leases, capital and tax leases. Each of them present a different tax advantage and different ways in which you can expense the item being financed on your tax return. So talking with your CPA and checking in with your lender to see if this is a useful tool for your operation is recommended. But the advantage to capital and tax leases is that it can help preserve working capital in the short term, in that you're able to finance up to 100% of the item that is either being purchased or financed. And what that means is that it helps save the down payment that's required on that purchase, generally anywhere from 20 to 30% down for an equipment item that lenders might look for. But under a lease, it allows the borrower to finance up to 100%, preserving that working capital that you would have initially put down as a down payment. Leases can finance machinery and equipment for vineyard operations. It can finance winery equipment, as well as winery capital expenditures and improvement projects within the facility itself, barrels and solar. The terms for leases generally are going to match the useful life of the item being financed. So anywhere from 3 to 10 years, you would see those structured. And again, just checking in with your lender to see if this is a useful tool, and your CPA in terms of the tax advantages, highly recommended. We'll go ahead and move on to the next slide, where Scott will be wrapping it up here for us this morning and really diving into how to engage and communicate with your lender in times of distress. So Scott, I'll let you go ahead and take it over.
Perfect. Thank you, Deanna. So again, my name is Scott Clifton. I work in our credit resolution group, which I handle borrowers experiencing distress in their organizations. And the thing about distress that's a little bit different, most everybody who starts a winery or grows crops, it's either a generational thing or they started this business themselves. And so there's a lot of pride and ownership. There's a history of, pride in being an agricultural organization. And so when this happens, when something happens, either COVID or wildfires or, any of the million things that can kind of affect agriculture, it comes as a shock to most people. And so nobody expects to be here. And so it's something that you don't plan for or don't expect. And most people will shut down. And so the key, if you go to the next slide, is really being proactive with your lender. So a lot of people might not think they need help, might think they can get through it on their own, might think, hey, I just need to, barrel down and tackle this. But really, your lender is a partner in this distress that you're experiencing. And our job isn't to hammer you, make you feel bad or anything else, but it's really to be a partner and figure out how we can help you get through this and get through it and be stronger on the end of it. So, the items to really discuss, the lender's going to want to talk about is, if you can't make your payment, when can you? What does your cash flow look like? Is it temporary? Is this still going on? Is there an end date? And then again, how have you changed your business model maybe to reflect the changes that you're seeing? And then, again, are there any other creditors? Is this an issue just with us, or is it going to be an issue with other people that we need to look for as well? And, the last part about that is being prepared. Talking through early is good, but then also having some numbers to back it up, either coming or, projections also help us, because the more information we have during these times, the better decisions we can make for you and for us. So going to the next slide, the options that a lender has, there's a lot of options. And again, the nice thing about American AgCredit is we're very well capitalized. Our mission is to help agriculture, and so we do treat it that way. In my group alone, I've done this for 7 years, and I handle all of Hawaii, California, Nevada, and I foreclosed on one person this whole time in 7 years, and that was the result of 2 bankruptcies and really a long drawn out process. So we really do try to work with our borrowers and use these options to create a resolution that fits for both parties. So the first option on the sheet is rebalancing the balance sheet, and that's something you're going to do with somebody like Deanna or Clay, where there might be a one-time loss. Maybe your inventory is getting a little bit too heavy, and you need to recapitalize, get some liquidity in that operation until you can sell down and convert that inventory into cash. And so we can lend additional funds to really help your winery really bridge that gap, I guess is the key. So that's one option to do is move some debt from the long term, put some debt in the long term, move it up to the short term and get you some liquidity. Debt service. So extended reamortize. Again, this is something that Deanna and Clay would do, is take a 10-year loan that has higher principal payments and maybe put it over 20 years. Lower that debt service that's due every year, which then would increase liquidity into the operation and allow some flexibility in making your payments. Another thing that American AgCredit did this year, which was new to us, is COVID deferrals. So we sent all of our borrowers that were not deemed high risk an offer to take 6 months of deferrals in payments or 1 year of interest only, to proactively say, hey, we know this is unprecedented. This isn't something that is your fault, and we're here for you to stand and inject some liquidity in the operation with no questions asked. And so that was a deal that we've sent to all of our customers, like I said, that weren't high risk already, to proactively try to help and get through this pandemic. So next slide. This is more where you'll see me show up with the lender if you're in this situation where maybe there's already some risk in the operation. Maybe the business model wasn't working out. Those type of issues where it's a longer term distress. It's not maybe a one-time deal. So when that happens, typically our first option is to restructure the loan. And restructure generally just means changing the loan terms, and that can be anything. That can be the term of the loan. That could be deferring payments for a certain amount of time, capitalizing interest to get you current and to allow you to kind of start new on the loan. There's a lot of different things that we can do in the restructure, and it really does depend on what your operation needs, and it's very specific to that. So everybody has different lenders, and so if that's something you think you might need, talk to your lender and explain why, and they can help you kind of determine what the best fit for you is. Forbearance. Well, forbearance is a little bit different than a restructure in that you don't change the loan terms. The loan would remain in default, but the lender's saying, we want you to do X, and usually X is probably sell something, lower your debt amount to try to get it maybe in line with where your cash flow is. And during that time, the loan will stay in default, but we're not going to take any action against you during that time. We're not going to start foreclosure. We're not going to put in any default interest or any of the tools that the kind of lender would have. We'll sit tight while you do what you do, and then when you come back, hopefully either the loan's cured or there's some other resolution that could be part of that process. And the last one is one that lenders don't really like talking about, but again, when communication breaks down, when there's no other tools in our tool belt that we can use, this is usually where we'll have to use these tools. So starting foreclosure, litigation by either suing an obligor or filing a replevin action, which is something you would do to take possession of chattel, or obtaining a judgment. So again, we don't do this a lot. It's likely only happens when communication's broken down and we can't get to a resolution, but it does happen, and again, that's kind of the last stop on the line. So that's really all I had. I'm going to turn it over maybe to Kristen, and we can see if there's any questions. Thank you.
Right, thanks, Scott and everyone. Any of the attendees, feel free to type your questions in the Q&A box. We do have a little bit of time left, so I did have some questions queued up for our group. Scott, if I could start with you. You had mentioned that you've only been part of one foreclosure action in 7 years in your role. Can you talk about the current environment of what sort of distress you are seeing? Even if it's not quite foreclosure?
Sure. When COVID hit, the first thought I had was that bankruptcies, and foreclosures were going to go up. What we've seen is through the PPP program and the government assistance during this time has really delayed any of those. So I actually don't have an active bankruptcy going on. Usually I have about 5 or 6 that I'm working through at any given time. So most of this distress I've seen has been kind of delayed. It's expecting lower profits, lower sales in the future, and so I'm kind of gearing up for that. So being proactive in how they address those. Question.
Thank you. Matt, I was going to ask you a question as well. If there was one resource that a winery could follow to look at the state of the economy, what would you suggest?
Yeah, good question. Thanks, Kristen. I would definitely recommend following tracktherecovery.org, which is an offshoot of the Opportunity Insights. It's where I got all that high frequency data from. When you go to those slides, you can see them when they're posted. You can see the website. You can see the website link and the documentation there for those slides. On that webpage, you'll be able to see slides on COVID, government restrictions, consumer spending, business income, all sorts of different job posting information, just tracking everything on a day-to-day balance. And I find that that website just absolutely great. I would highly recommend it.
Great, thanks. Clay, can I turn it over to you for final thoughts?
Yeah, thanks, Kristen. Hang on here, looks like something popped up in chat. Okay. Oh, it's not a question. Thanks to everybody for joining. Again, this resource page here is really important. Go ahead and call for our Vintner partners. This is going to be key for you guys. We've got an economist, we've got an appraiser, we've got a crop insurance, we've got lenders, we've got credit resolution. And all these guys are standing by and they want to help and they want to hear from you. So again, questions, you can call directly to any of these individuals as a follow-up. But again, want to thank our host and thank our participants and thank our panelists. So much appreciated. Take care, everybody.